I've been waiting for a long time to find the right currency trade on the euro dollar. We finally got it. Price pulled back. What did I say? It was 5 days ago. Hold on. Forex trades. 5 days ago. I entered this euro short 5 days ago. Part of the reason was showed up here on the watch list as a bearish reading at -8. It's a pretty strong reading to potentially look for bearish setups. COT data really swung it. So we saw institutional money kind of getting heavily bearish on the euro. In fact, let's go look at that just to confirm that idea. So COT data, look at this. On the euro side of things, you have institutional money pretty positioned on the short side of the euro. So euro contracts, actually it's not super tilted, but 54% short. So a slight preference for short side action. But then look at this. They bought the dollar really heavily in the latest filing. Institutional money at the same time sold and even added shorts. Look at this. They actually added number of short contracts changed. They added a lot of short contracts and they reduced a significant amount of long contracts. So that is very interesting. The latest round of COT data comes out every Friday and our software automatically populates it in here so that you can look at it. And the best part about that is today and until Friday, the software is 100% free. Russell's down 1% now. Had a quick drop off here right at the start of the stock market open. You can see here's the 5-minute chart on stocks. Dow Jones holding it together, but NASDAQ really tanking. Same thing with the S&P 500. I mean, not tanking. This is down 0.3%. But you've got here in just a moment, 10 a.m., you've got two figures coming out that are pretty important to the market. You've got the JOLTS job openings in the US, and consumer confidence. Both of those really important data points to keep an eye on. Now, what do these things tell us? Well, job openings are pretty obvious. If you have lots of job openings, that's generally a good thing. It means companies are looking to hire, perhaps the economy is doing okay. And at the same time, consumer confidence is also very important. This is a survey that asks the consumer, right? It polls this consumer to ask them key questions like, are you taking a vacation this year? Or do your finances feel better or worse than they were a year ago? And things like that. So we'll get the consumer confidence report here this morning, as well as the job openings report. And these are important figures to keep in mind. Last time we had 8.04 million job openings posted. The forecast for today is 7.98 million. So the way to read this is that if this number comes out higher than expected, that is probably a positive thing for the US dollar. Same thing with the consumer confidence. Let's just say we have good data points for both. That would be, in my opinion, good for stocks, good for currency, for the currency, the dollar, right? Probably not great for gold if you get solid numbers. For the opposite, let's flip that around and just think about it logically, right? If you hear that the consumer is feeling the pinch and job openings are tightening, what does that tell you about the state of the US economy? It's not great, right? Or that would be a less ideal picture being painted, which would tell you dollar index could see some downside move, and at the same time, stocks could slide a little bit further, and meanwhile, people might rush to gold. Does that make sense? Are we on the same page with that? Just sometimes with these economic data points, it's not rocket science. You just kind of have to think about this like logically. Job openings. If there's lots of job openings, what does that do to the market? Remember, security, stability in the economy, that's not particularly great for gold. It doesn't mean that gold has to crash if you get good job openings data, but it's one more factor to think about. Sometimes people get really confused about fundamental analysis because they overestimate the importance of one statistic, right? There's a lot of statistics that paint the full picture of what economic data is telling you. So what we've tried to do with our primary tool here, the EdgeFinder, is we've tried to take a collective view of what these data points are telling us, generally speaking, about the economy, to give us a soft bias, if that makes sense, right? So when we want to do fundamental analysis, you can't only look at the consumer confidence report. That would be foolish. That would be like just only looking at one candlestick or looking at just a moving average or something like that. You would probably want a little bit more to help you make decisions. So what we look at is we look at things like the GDP numbers. That's the economy's overall growth. PMI numbers, which show you what purchasing managers, key players in the economy, are forecasting for their own businesses. If you have a business and you do car manufacturing and you see like in the future there's a ton of orders coming, or you're hiring a bunch of people, that would be a sign of, hey, the economy feels pretty good to me. And that surveyed across all of America is really important stuff. So these are some of my favorite economic data points to watch. Retail sales, is the consumer out there spending? Inflation, what are prices doing, right? Employment data, are people getting hired? Are they losing jobs? These things are important. And of course, interest rates, which is like the multiplier effect to the whole thing. If you understand this stuff at an in-depth level, the markets and charts will start to make a lot more sense to you. Instead of you just being like, oh, the big price jump, right? Understand why these price movements are happening. And sometimes it can help you to see what may be coming down the pipeline. You know, this EdgeFinder thing is pretty cool. I can trade it all sorts of different ways. And for me, I like using fundamental analysis and macroeconomic data to try and make better decisions. What do you like to use it for?
I'm more of a proponent for the COT data or the business forecast tool.
Did your tooth just fall out?
It was my baby tooth. It'll come back. Hey, at least I don't burst into flames when I step out into the sun.
Trading without the EdgeFinder can be scary. The EdgeFinder keeps you up to date with all the most important market-moving information. Check out the latest COT data, retail sentiment, fundamental data, and so much more. This week only, you can have 100% free access to the EdgeFinder. But don't wait. This offer is available for this week only. If you want access to COT data, top setups, and so much more, click the link being dropped in the chat now to sign up. Again, this is 100% free access to the EdgeFinder, available this week only, so don't wait or it'll be too late.
Okay, so gold on the 4-hour and daily chart just looks really strong. You know, you may see pullbacks, but it's not something I'd bet on, right? I think gold could just do this, right? Very, very easily could just drift higher and higher. It's what it's done all year with very minimal pullbacks, right? If you've been waiting on gold to give you a big old pullback this year, you've been waiting for a long time, right? There's been hardly any major pullbacks. There's been slight ones on the daily chart, but nothing like, you know, a big move and then a huge correction and then a big move and then a huge correction. There's not been a lot of that. So if you're watching gold right now, will that change at some point? Yes. But what are the chances that you're going to call that to the T when that gold trending personality changes? In my opinion, I'm not good enough to call when that's going to happen, right? And I don't need to be. I'm not a genius, right? I don't need to be a genius to make money in the markets. I just need to trade what's in front of me, trade what's happening with good risk management, rather than try and be a superhero and say, gold's going to top out right here. It's going to crash by 15% and I'm going to make a ton of money. That's like you're trading in hard mode. Right now, gold is moving up. The path of least resistance is more upside until something changes. Doesn't mean that it's a certainty that's going to go up, but nothing in trading is. And I speak in these over and over ways of saying these things because I know there's new traders in the room that are like, well, Nick, where's it going to go? Is it going to go up? Like, when you watch my live streams and videos, what you have to understand is I am not a market god that can call what's going to happen next. And newsflash, professional traders are not either, right? Generally speaking, professional traders are just taking probability-based trades every day or week, whatever they trade, and just letting the edge play out over time. So for example, in my opinion, if gold dips and we get a good reason to potentially look for long setups, there's a good chance, not a certainty, but a good chance that this could bounce and continue and I could make money. And in the case that I'm wrong, I lose a small amount of money and I move on. The difference between what people often think professional trading is and what it actually is that people think professional traders just have some hidden secrets to knowing what the market's going to do. And what you come to find out over the years of improving in the markets is, wait a second, professional traders don't know with certainty what's going to happen ever. They're just trading a slight edge over and over and over. Imagine if you and I were sitting at a table and we had a coin that when you flipped it, 55% of the time it hit heads, 45% of the time it hit tails. Now, if we flip that coin over and over and over, eventually the person who bets heads over and over and over is going to make more money. But it's not a magical trend like this, right? If we were to plot out together, if you and I were sitting at a table, we're flipping coins, and let's say you took the heads every single time. If you bet all your money, you could lose all your money very quick, right? Because a couple bad streaks, you're out of the game. But if you risk a tiny amount per coin flip and sat there and flipped that coin over and over and over, eventually, with time, you would win tremendous amounts of money. You don't need to be a market genius and call everything correct. You need to risk tiny and have a slight edge. That's the secret. The secret is not glamorous. That's why people spend all their time obsessing over trying to find a holy grail trading strategy when I just told you how 99% of profitable traders that I know, that's what they do. They flip a head and it's essentially a slight probability of winning that they apply over many years. We've got stocks in the left-hand side, your 4 major US indices. You've got the dollar here, gold here, silver, and oil. Gold is making a push higher here. We'll see how the jobs data comes out. We got about 1 minute to go, guys. Please, if you're somebody out there about to gamble on this stuff, I can't stop you, and I'm not your dad, and I'm not your financial advisor, but be careful. A lot of people gamble this stuff. They lose everything, and then they're like, but I thought I was slick with it. Buy stops, sell stops on both sides of the news is a dangerous game. Got our breaking news coming in just a moment. What bond should I be looking at, 10-year or 20-year? I look at the 10-year the most. Okay, guys, got about 10 seconds here to go. Stick around after the spike if there is one. I'll do my best to try and break it down as much as I can in simple, fundamental, friendly to newbie traders perspective. All right, dollar index is lower here. S&P and NASDAQ slightly higher. Gold pushing higher off of some drop in the dollar. Stocks muted or flat. I'm going to guess that jolts came in a little bit light and consumer confidence came in about as expected. Let's see if that is correct. That's my guess. I could be wrong. Let's just see. Dollar definitely lower now. Gold up, silver up. Stocks about flat off of that reaction. Come on, Forex Factory. Okay, there it is. Jolts came in a little bit light, actually pretty light there. So we're correct about Jolts. I mentioned consumer confidence. I'm expecting it to come out as expected. We'll see. Or close to as expected. Let's see if we were right this morning. Slightly better than expected. So I was wrong on this, but Jolts came in real light. So that is probably why the dollar dropped pretty good here on the hourly chart. Nick loves to show demo accounts. Check out my demo account. I mean, you kind of set me up for that one. You set me up. You should have come back and said that when I didn't have trades working out. Where were you? Let me show you. Let me show you when you should have said that, because I had a really rough couple months here. Let me just make sure I'm not doxing myself in any way. Okay. You should have said show me the account back here, because last month I lost $24,000. The month before that I lost $7,000. I appreciate you guys. The thing is, I've made the decision to show my trading account frequently, despite the immense stress that it puts on somebody to show their trading account. I genuinely understand why some other creators prefer never to show that sort of thing. I do think that it's important that if you're going to sell something, you show something like that, because it shows credibility. But I'm telling you, it is an incredibly difficult thing to do, because there are times I've had a good year. I showed you a chart there that was a good year. I'll show you guys. You want to see a bad year? You guys want to see a bad year? Hold on. I just don't want to accidentally show my personal information. A bad year looks like this. Okay. So here's a good year, 2023, great year. But even a great year last year, look at this. 1 month I'm down $10,000. The next I'm down $22,000. And then after that, I lost another $26,000. So please understand, there are good times and there are bad times. But when we talk about, swings, and here's a really bad year. 2022 was an awful year for me. As you can imagine, doing that publicly tried me. It tried my life, if you will. 2021 was a great year. 2020 was a great year. But 2022 beat me the F up. Okay. So there are good times, there are bad times in the markets. It is all about long-term profitability. You are going to get beat the crap out of sometimes, even if you are overall profitable. It is inevitable. That is why trading is difficult. That is why I don't recommend it for 99% of people. And it's not that I'm some genius that figured it out. It's not even that. It's just that I really love this stuff, and I've dedicated my career and my entire passion and work to doing this stuff. If you don't match that energy, you shouldn't trade. That's why I say it's not that I'm a genius. It's that I'm insane, actually. And other traders that I know who are becoming profitable or who are already profitable would also classify themselves as insane to keep doing this, because the emotional swings are hard.
Nick, they had a pretty strong revision, man. We were down just under 200,000 on the revision and missed by about 500,000 jobs on the Jolts report. That's pretty substantial.
Chris is definitely, and what had surprised me by that is that the NASDAQ and S&P kind of held up in that, but at the same time, yields didn't even really go down. So I'm a little confused by that, right? You would think like, oh, pop on cool jobs data, that means maybe they cut or cut rates or keep the rate cuts coming kind of thing. But we didn't even really see yields drop yet. The market kind of popped in. And look at gold acting like, it loves that. So interesting to see. Bonds are trading so uniquely right now, Chris.
I mean, the yield situation is basically calling the Fed's bluff. They're going to say that this entire this entire movement is going to be inflationary, and the Fed's going to have to do something to basically do what we said is going to happen all along, which is they're going to break something. The bond market's going to break something. The bond market's going to price in something like things are rougher.
And gold's
Inflation's
telling
getting
you that
worse.
too, right?
And
If
gold's telling us
something's
that
going to
too.
break, gold
Yep.
is warning of that potential. Chris, I want to talk about all these markets, but I have to ask you to back me up on this thought process I had just before you joined on. I
Okay.
said, I mentioned that for 99% of people, I would actually not recommend trading. Like, trading is so difficult to try and get to that point. The reason I bring that up is because I think you kind of had to. I said I think I probably would classify myself as slightly insane to do this for so long and to carve out, making money in the markets. It's been so incredibly hard. Do you feel the same way? Do you have to be? Would you classify yourself as slightly insane? Because I would call you slightly insane, like myself.
I don't know if I don't think I call myself insane. I think I call myself just really competitive, because at the end of the day,
Yeah.
this is a competitive streak where, I like to win. And I realize, like, trading is not about winning, it's about making money. It's not about being right, it's about making money. So that's part of the journey that you have as you are a trader, is you realize that it doesn't matter if you want to be right for your ego. It feels good, but it doesn't reward you necessarily, because you could
Maybe the
justify.
phrasing then is insanely competitive.
There you
and
go.
That's probably valid, and it's why but not only that, the last thing I want to add to that, you have to be insanely competitive, but you also have to, like, really, really like this stuff. Like, it's beyond just like, oh yeah, I'm competitive and I like to challenge, but you actually, like, you could employ those resources in engineering and becoming a doctor, a lawyer. There's many ways you could employ that competitive nature. You have to really love learning about financial markets, price action, technicals. So yeah, I just wanted to end
In a
that
way.
conversation.
So I'd say full-time trading, you're absolutely right. But having some type of passive approach, where example would be this. If you just learn how to trade a basic option trade, a basic credit spread, and you trade that on the index over and over again, that there's nothing wrong with that. You don't have to be super competitive. You don't have to be knowing everything about the market. It's like, if you understand that there's defined risk in this trade, the most you can lose is what is traded up front. The most you can win is what's already predetermined, and you can do this consistently every week, every month, every quarter, whatever you're comfortable with. And if you give it time, I mean, question here, Nick, do you think that the S&P, let me show my screen here, or you've got it. Did I already have it?
I got NASDAQ pulled up.
Okay. So where do you think the S&P is going to be in 10 years? Higher or lower?
If it's lower, something went terribly, terribly wrong. So
Exactly.
probably higher.
Probably higher. I mean, we've mentioned Tom Lee on the show before. I mean, Tom Lee's talking about a doubling or tripling the S&P over the next 5 or 10 years. I mean, if the S&P is going to get to 10,000, it might be after a pullback to 4,000, right? It might be after a pullback to 4,500, but more than likely it is designed to be at 7,500, 8,000, 9,000, 10,000 as the haystack keeps improving, as better companies get stronger. This whole thing with AI is either the greatest amount of expenditure, with the risk being possibly not being able to provide enough energy to support AI, or support the energy needed to run these crazy servers and whatever we're building out there in CapEx. And I also wonder if it's easier to trade AI than trying to get into like these crazy private equity plays. AI could be as simple as trading the NASDAQ and trading your Mag 7. And I hate to say it because it's so concentrated, it feels like it's too easy. But at least the NASDAQ would be the top tech stocks. I mean, the S&P is going to be your broader basket. Your Dow is going to be your price weighted and your bellwethers. But the NASDAQ is going to be probably your index that's better, I'd say, positioned for tech and deflationary pressures. And if we have this AI stuff that's really causing more efficiency, better profit margins, the NASDAQ itself is a pretty good way to be playing it. So
I agree. There's so many different ways to play it. And Chris, we've got that webinar coming up. Maybe Chandler or James, you guys could drop the webinar link for us in the chat. Chris and I are doing a webinar talking about like top ideas for 2025, but that's a subject that I definitely think we should dive into in the conversation, is like, okay, how to play AI. yes, you could go out way on the risk curve and you could say, I want to buy unprofitable tech companies that are promising AI revolution. You could do that, but you could also look at energy. You could also maybe look at like pseudo ideas like Bitcoin, even. Like, what if we, look at, just internet businesses in general? What if you're looking at, there's so many different ways. As you mentioned, maybe the most diversified way is to trade NAS and play the queues and just say, look, the cream of the crop will rise to the top of the queues. That's just how it always goes. As you mentioned, these things are designed to go up over time. Now you can greatly outperform them by picking the winners, but that is of course easier said than done.
Yeah. And that's not guaranteed. And honestly, that's way harder to do in the long run. Picking
Yeah.
stocks is way
So
harder to do
difficult.
consistently, because if you look and see, I mean, you can go back and if you really want to nerd out on this, go back like 30 years and look at when the S&P or the SPY was first created, the QQQ was first created.
Yep.
Look and see what the top 10 stocks were, the top 10 holdings. This is market cap weighted, right? Look at those top 10 and look at the percentages and go from day one of the SPY and Qs all the way to now and see that it's not the same companies. I mean, the Mag 7's been a pretty good runner. We've had like a decade essentially of these tech companies leading the way. But before that, your top 10 holdings, your best performers were all different names and all different sizes. And so that's why the long run stock picking is challenging, because it's always going to change and always going to ebb and flow.
Chris, that to that point, I recently saw something about the NASDAQ 100 index only contains, and I somebody please fact check me on this, but I believe it's something like the NASDAQ 100 index since inception, it's 100 stocks, right? It only has like 5 or 6 of the initial companies. And maybe the ones that are in there that might not surprise you are, I think Costco is one of them. There's like Costco is actually in the NASDAQ, which I didn't know until recently, but there's a couple names that have been in there forever, but the vast majority, as you just mentioned, the way stocks, how the bricks fall, if you will, is that over time, most companies fall off the wagon, and the wagon keeps rolling, but new players are in it. I mean, I love to trade the indices for that reason. And most of what I do in individual stocks at this point, Chris, is now options plays. I mean, I'm doing the wheel strategy on a couple, a diversified basket of some of the biggest conglomerate companies. That being said, even those can fall off, right?
Yeah.
And what's the one, the 2001 stock that was ginormous that fell off? Cisco. Yeah, Cisco.
Still 70% away from the all-time highs.
Yeah, guys, we have to remember that when you look at Cisco, this is a history lesson that's very important. Cisco at one point was the NVIDIA of the days of past, right? Look at what happened back in the 90s. It just went, I mean, if you were long this stock, just an 87,000% gain, like just a casual. So my point with that is that at the 2001 crash, it lost 90% of its value and has still been working to get back to that all-time high. So just something to think about. But good points there, Chris, on just the importance of understanding the index versus individual stocks. And I guess next question for you, what's gold doing? Is gold just going to have a melt up year next year too?
I don't know how long this can keep going, but I mean, we've had a decent stretch. The last time we tested on the daily time frame, this is the 200 moving average, we're up 269 bars. It's not crazy overextended. And on top of that, we keep having these like pushes and pauses. Now it's getting more and more, it's getting faster. I mean, we had a long pause cycle here, a long pause cycle here. This was shorter. I mean, I guess if I look at this chart and all we test is like the 21, and we just keep getting what I'm looking at here, Nick, is the further we get stretched away from the 200, that's probably what I'm looking to call more of the top. How would you read? So in EdgeFinder Pro, I looked at this morning. Where did it go? Right here. So am I reading this right? That if I'm looking at the COT Smart Money Indicator, that right now it shows that retail is still lower than the net positioning of the COT, which means it's more institutional flows right now than it is retail. Yes.
Yeah, and that's what's interesting is when you look at this chart, you got the blue line going up and up and up. That's COT week to week filings,
Yes.
showing institutional money has been, to be fair, if we could drag it out to 2023, I don't think we can on this chart. I don't think it's functional right now. But the 2023 showed the same thing. It was like buy, 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 buy. That actually interesting at the very end of your thing there, Chris. You got the blue ticking lower. If that stays the case for a little bit, maybe institutional money's played their hand. I'm not sure.
Well, because I was wondering, I think the toppiness would be if retail gets bigger into gold. I mean,
Oh yeah.
we have been talking about gold all year, but obviously this isn't the entire retail crowd. We've got a decent chunk of, we get great viewers here on the network. But when I look at this, I wouldn't really be super bearish on gold unless we have just an absolute monster blow off move and it stretches so far away that it's like, okay, now we're expecting to some type of correction, some type of reversion. Because usually what happens is if we have a bull market like this bull market can just stay the course and look pretty healthy for a while. What gets to the point where we have to be a little bit more protective would be if this thing just blows off and gets so vertical that I'd be more concerned about how that ends up correcting and reverting. So until we get either a blow off top, which we can then move stop losses along the way and just trap it. Otherwise, I think this is just up and steady, and our quicker moving averages will catch up, and slow and steady. To me, it still looks pretty good.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.